When you take out a student loan, the lender pays for your college degree and associated expenses. You repay these funds over time according to the loan agreement. You can use your loan to cover tuition, fees, books, supplies, and living expenses. You're eligible for a student loan if you've enrolled at an eligible school, are at least 18 years old, and have a high school diploma or an equivalent. Most lenders will also require you to be a U.S. citizen or permanent resident. Hello everyone and welcome back to my channel. Today we will discuss about student loans and repayment options for these loan schemes. Student loan repayment options. There are 4 federal student loan repayment options to choose from, but the best one for you will likely be the standard repayment plan or an income-driven repayment plan depending on your goals. Number 1. Standard repayment plan. The standard repayment plan is the basic plan for repaying student loans. You're automatically placed in this plan when you start repayment, unless you select a different option. Here are the key details about the standard repayment plan on student loans. Repayment length is 10 years. Number of payments are 120. Payment amounts is the same amount each month. Other qualifications are must-having federal student loans. Number 2. Income-driven repayment plan. These repayment options tie the amount you pay to a portion of your income and extend the length of time you're in repayment to 20 or 25 years. When the term is over, the remainder of your debt is forgiven. IDR is best if you're having difficulty meeting your monthly payment and need something more manageable. Number 3. Graduated repayment plan. These plans lower your monthly payments and then increases the amount you pay every 2 years for a total of 10 years. Number 4. Extended repayment plan. In this option, start payment amounts low and then increase every 2 years for a total of 25 years. Or you can choose a fixed version which spills payment amounts evenly over 25 years. Here's how to decide which payment plan is right for you. If you want to pay less interest, then best repayment option is standard repayment. On the standard student loan repayment plan, you make equal monthly payments for 10 years. If you can afford the standard plan, you'll pay less in interest and pay off your loans faster than you would on other federal repayment plans. If you need lower student loan repayments, then best repayment option is income-driven repayment. The government offers 4 income-driven repayment plans: income-based repayment, income-contingent repayment, pay-as-you-earn, and revised pay-as-you-earn. These options are best if your income is too low to afford the standard repayment. Income-driven plans set monthly payments between 10% and 20% of your discretionary income. Payments can be as small as $0 if you're unemployed or underemployed and can change annually. Income-driven plans extend your loan term for 20 or 25 years, depending on the type of debt you have. 20 years for only undergraduate loans or 25 years if you have any graduate debt. At the end of that term, any remaining loan balance will be forgiven, but you pay taxes on the forgiven amount. If income-driven repayment doesn't make sense with your salary, then best repayment option is graduated student loan repayment plan. If your income is high, but you want lower payments, a graduated plan may make sense for you. Graduated repayment decreases your payments at first, potentially, to as little as the interest accruing on your loan, then increases them every 2 years to finish repayment in 10 years. If your income is high compared to your debt, you may initially pay less under graduated repayment than an income-driven plan. This could free up money in the short term for a different goal, like a down payment on a home, without costing you as much interest as an income-driven plan. You would still pay more interest than other standard repayment. And the last, if you don't want payments tied to your income, then best repayment option is extended student loan repayment plan. The extended plan lowers payments by stretching your repayment period to as long as 25 years. You must owe at least $30,000 in federal student loans to qualify for extended repayment. You can choose to pay the same amount each month over that new loan term, like under the standard repayment plan, or you can opt for graduated payments. Whether you choose equal or graduated extended payments, you'll have a good idea of what you'll pay each month in the future. Under income-driven repayment, payments can change annually based on your income. If your salary jumps, your payments will too. But extended repayment does not offer loan forgiveness like income-driven repayment plans do. You will pay off the loan completely by the end of the repayment term. If you want to pay off your loans faster to get rid of your debt sooner than your monthly payments allow, you can prepay loans. This will save you interest with any repayment plan, but the impact will be greatest under standard repayment. Just be sure to tell your student loan servicer to apply the extra payment to your principal balance instead of toward your next monthly payment. If you qualify for public service loan forgiveness, the best repayment option is income-driven repayment. Public Service Loan Forgiveness is a federal program available to government and certain nonprofit employees. If you're eligible, your remaining loan balance would be forgiven tax-free after you make 120 qualifying loan payments. So guys, this was all about today's topic. See you soon in the next video. Goodbye.